Hello everybody, my name is John Sparks. I'm a tax director with Westcotts, and I'm here with my colleague Richard Tyler, who's a tax partner, and we're here to talk about Seed Enterprise Investment Scheme and the Enterprise Investment Scheme. So Richard, you're going to talk us through some of the complex issues that arise with these two tax relief schemes. In simple terms, can you explain what are Seed Enterprise Investment Scheme and Enterprise Investment Scheme, and why are they important to early stage businesses?
Great. Thanks, John. So as you say, we're here to talk about two government-approved investment schemes today. First is Seed Enterprise Investment Scheme, and second is the Enterprise Investment Scheme. They're both similar but have subtle differences. What they both involve is investors subscribing for shares in early-stage companies, in startups and high-growth early-stage companies, and government giving tax incentives to those to investors to encourage that. So what they acknowledge, I think, it's designed as a way of encouraging investors at the very early stage of a business to make what might be a more risky investment by giving them tax incentives such as an income tax relief based on the amount they invest, and potentially the ability to defer capital gains, and also to make tax-free capital gains on the eventual sale of their investments in those companies. Mm-hmm. Founders and people running startups really need to be aware of these schemes, because investors very often are looking for companies that qualify under these schemes, because it's a big selling point with investors to minimize it. It reduces the risk of their investments because they're already saving tax, whether or not the investment succeeds. So we know that there's a limited amount of money out there, and that the founders are fighting against other founders to get money from that pot of investment, and making sure that your business qualifies as an investment under the SEIS or EIS scheme is a good way of making your business a more attractive investment for those investors.
Yeah, okay. And I guess in my experience with this one, the types of businesses that are looking for this kind of funding maybe have already exhausted grant funding, for example, or may not be in a position to be able to get funding from a bank, or indeed they may have had some sort of friends and family type capital that they've used up. Yeah. So this is kind of like the next stage in their evolution.
I think that's right. It's quite often, I mean, these are professional investors or larger scale investments that are being made under these schemes, and as you say, it's the, if you like, the next stage of your startup journey, when you've exhausted your own funds or need an investment for a big product development or a big increase in marketing or something like that.
And quite often, a lot of the potential investors are people that have had businesses themselves in the past, so have some, as well as their cash, they've got some business expertise and support that they can bring almost as a sort of
added bonus.
Added bonus,
yeah. No, I think there's definitely a network of angel investors out there who are keen, have money because they've been successful in the past with their business ventures, and are keen to get involved and are actively seeking investments with those tax reliefs, but also are keen to get involved and help grow those businesses. So you certainly can leverage their experience.
Yeah, okay. So in terms of, potentially a really good opportunity for growth businesses and startup businesses to get some funding in to help with fast growth.
Yep.
But what sort of companies would typically qualify for SEIS or EIS? So we're going to shorten Seed Enterprise Investment Scheme and Enterprise Investment Scheme to SEIS and EIS respectively, because it's a bit of a mouthful.
It is.
So what sort of companies qualify for those two investment schemes?
Yeah, okay. So you're looking at UK trading companies, essentially. There are a list of excluded activities, things like leasing, property development, some accountancy and professional services don't qualify. If you think about the idea behind the schemes, it's to encourage investment in essentially risky new businesses.
Yeah.
So they really want to encourage investment in genuine trading companies within the UK. In terms of what the two schemes are aimed at, SEIS, the seed investment scheme, is for very early business, very early stage businesses.
Yeah.
It's there are limits on the total amount of assets of that company. I think it's going up to £350,000 from April 2026. EIS is essentially the next stage for bigger businesses, and that they can have assets of up to 30 million from April 2026.
Yeah, and those limits have gone up recently.
Those limits are going up. They were announced. The changes were announced in the budget last year in November, and they are going up with effect from April this year.
Yeah.
So you need to be a trading company. You need to be independent, i.e., not controlled by another UK company or an overseas company. So the investment has to be in the effectively the independent company. You can have some qualifying subsidiaries if you're at that stage of your business, but generally it's a standard. Certainly for the SEI scheme, it's a standalone UK trading company that would generally qualify.
Okay. And you mentioned some types of businesses that won't qualify.
Yeah.
Are there any others that people should be aware of?
So there is a list, but it's generally if you think about the principle involved, it's generally those that are less risky, where there are asset-based businesses like leasing or care homes and things like that. Where there's a lot of property assets, perhaps that are backing the investment. So the capital isn't in as much trading risk as would be in a genuine trading company. Yeah,
that makes sense. So it comes back to the conditions are around investors taking a risk.
Yes,
on
exactly.
what they're doing with their money.
Yeah. And I think if if I was advising a founder, you'd be wanting to consider whether anything in your business activities causes a problem at an early stage when you're starting to seek those investments.
Yeah, because I guess some startup businesses could have multiple income streams.
Yes, yeah.
Where they may have something that's a little bit more risky, but they may have another activity which is bringing them some money in at an early stage to effectively fund the risky bit, which is potentially, in my experience, that's where actually you can have some problems, because it's that less risky bit that's generating you some cash, which has a knock-on effect.
Yeah, absolutely. No, yeah, absolutely.
Okay, so thank you, Richard. That's great. If I'm a founder, you talked initially about getting myself ready to have investment from potential angel investors, and one of the ways that that can happen is through the advanced assurance process, and that's something that potentially can give some comfort to investors. Can you explain what that advanced assurance process is and what that's all about?
Yeah, absolutely. So as a founder, you might well have been approached by an investor who will ask you whether your company qualifies for EIS or SEIS relief, and before they commit to making an investment, may well ask you to seek advance assurance from HMRC. So that is a process by which you share some information about your business with HMRC.
Yeah.
There's an application form, and your Westcotts as an advisor would be able to assist with this process of filling in the form and producing the right information with HMRC. But essentially what that gives is HMRC will review a certain amount of information about the business and will give a qualified view as to whether the business and the particular share issue will qualify for EIS or SEIS relief. And it is qualified because there's certain information that they won't know until the shares are actually issued.
Yeah.
But more often than not, the investors will expect you to have gone for advance assurance before they part with their money.
Yeah.
So it is definitely it's not officially a mandatory process, but it essentially
the investors have kind of expect it to be done. The market expects it to be done. Yeah. And what sort of information, you mentioned information requests there for that advanced assurance process. what sorts of information are the revenue going to ask for? So if I'm a founder, and I now know that I need to go through this process, I might have got a lot of ideas in my head, actually.
Yes.
So am I going to have to start putting things down on paper? What sorts of information am I going to need to provide?
They really want to see all the information that you're giving to the potential investors.
Yeah.
So they can, if you've created a business plan and you're sharing that with investors, or they will want to see that, because that will set out the amount of money that you want to raise, the activities that the business is undertaking, what that money is going to be spent on, how quickly it's going to be spent. All that sort of information is really important to HMRC to make sure that the company is undertaking a qualifying activity, and that the purpose of the amounts that are being proposed are within the qualifying limits, and that the money is going to be spent on the right kind of things in the right kind of timescale. But essentially, it's all the agreements or potential agreements or information that you're providing to the
legal documents, things like articles of association, potentially previous sets of accounts,
any shareholder agreement, proposed shareholder agreements, things like advance subscription agreements, if there are any, if you had the money up front before shares are issued. Obviously the business plan. Details of all the shareholders, all the basics, as well as the details of the shareholders is an interesting one, because I think certainly I've had conversations, I'm sure you have, with people where they'd like to do SEIS or EIS, but they'd like to get they'd like to be organised and get their advance assurance in early, but they haven't necessarily identified all of the investors at any point. And does that create an issue? Well, the advance assurance form does ask for the list of potential investors, their names and addresses, and how much they're going to invest. So you can only do this process, the advance assurance process, go through that process at the point at which you do have some interest from investors. It's not just a fishing trip, effectively.
Which I think is what the revenue at one time. I think they felt they were sort of had to. Like a bit of a tie kicking exercise. No, that makes sense, and that's definitely something practically for companies that are looking at using either of these two schemes to be aware of. You need to do a lot of the donkey work and background stuff to get your business plans ready, to get your financial projections ready, and be ready for investment. But actually so you can do a lot of the background work early, but actually the formal process of submission, you need to have people identified that are going to come on board.
And, once submitted, it's a relatively speedy process for HMRC to look at the application and come back with their adjudication. So it shouldn't, that processing bit, the HMRC processing stage shouldn't delay an investment too much, but the groundwork is something that a founder really needs to address early on in this stage.
I think my sort of more recent experience is that it is a relatively quick turnaround now, and there was a period where it wasn't.
No, that's true
for certain, but I think that's a bit better now. Obviously, there's a lot of information to provide to the revenue, and we have got a lot of complicated conditions to meet, both in terms of the trade itself, the company, and actually the shares. And there are a lot of, in common with certain bits of the tax legislation, there are lots of fine detail rules. What do you see, Richard, are the sort of the common mistakes that kind of people make with SEIS and EIS and sort of the application process, if you like?
I mean, number one is leaving it too late, not giving yourself enough time to get all that information together. And potentially missing the boat on an investor who may well be time critical. The timing of their investment may be important to them if they are seeking to defer a gain or get some income tax relief for their investment. So that can be important. In terms of the constitution of the company and how the company is set up, you do need to be careful about shares, and particularly if you've got different classes of shares, whether you are doing something which could disqualify the investment as an EIS or an SEIS investment, and that involves essentially making sure that there are no preferences available to EIS or SEIS investors, that there's no guaranteed exits, things like that could sour the investment. And then in addition to that sort of initial period, and getting advance assurance, there is a 3-year qualifying period once the shares have been issued, where the company itself has to meet a number of conditions. And again, that can have very bad consequences for investors if the company fails to meet those conditions throughout that period.
Yeah, so that's almost worse in some respects than not getting the clearance in the first, getting the assurance in the first place, because at that stage the investors committed the money. Yeah. They'd done that on an expectation of getting a certain return and with the tax relief, and then suddenly something happens and you've ended up in a situation where that's all got to be clawed back. And
it's not from experience, it's not a pleasant conversation for a founder to have with a shareholder to say, absolutely, we've done something, perhaps we didn't take advice, or the advice was wrong, and unfortunately you've lost your 30 or 50% income tax relief.
Very easy to
and it will get clawed back in that 3-year period. So,
absolutely.
So it is easy to trip up, and it ought to be that compliance piece ought to be viewed by the founders as an ongoing requirement for those 3 years.
Yeah, absolutely. Couldn't agree more. Yeah. It's not about getting it through the door and putting it on the shelf and forgetting about it.
Sadly, it's not a 3-week job when you get your investment and then you can put it away and forget about it.
Yeah.
It's a commitment.
It's an easy trap to fall into, because the business wants to carry on and get on with the exciting things it wants to do and with the money. Yeah. And actually you could so you can easily get into that situation.
And I'd like to think that's where an advisor like Westcotts can come in and help.
Add some value,
there are effectively self-service web-based providers that will guide you through that initial process, but won't support you through that 3-year period. Yeah, important 3-year period.
Yeah, understood.
And in addition to all the other support that Westcotts can give you, we can certainly advise on changes to business plans and changes to activities that
might cause a problem. Yeah, great. So, in summary, then, what would you say are the most important things that a founder looking at potential seed EIS or EIS should remember and take advantage of in terms of these schemes?
So, I would say start planning early. If you think you want external investment, then get your business plan together. Maybe get that reviewed at an early stage to make sure you're not promising something or suggesting that the company does something which is going to preclude qualification for these investments, these investment schemes. Then definitely go for advanced assurance, even if your investor isn't insisting on it, which a lot of the bigger investors will. If it's family and friends that want to invest, then still go for advance assurance, because that at least gives you the reassurance that what you qualify at that point. And then thirdly, make sure your structure and review your structure, review your share capital, your share and your cap table. Make sure there's nothing in there which might cause a problem with the shares going forward.
Yeah. You mentioned friends and family there. Is it worth just touching on potentially that some of the family might not qualify?
Yeah, so there are some restrictions in terms of family members. If people are connected with the founders, or you end up amalgamating for these purposes, you end up amalgamating the founder's shareholding with their family and with their family members, and if they breach a certain threshold, then EIS wouldn't be available for those investments, but certainly for friends and colleagues and at that smaller scale, that's EIS or SEIS relief is a possibility for them.
Excellent. Well, Richard, thank you very much for your thoughts and observations on SEIS and EIS today. And from Westcotts' point of view, we obviously support clients with lots of these kind of projects.
Yeah, absolutely.
We're very much here to help with regard to these types of queries.
Yep.
And we look forward to speaking to you next time on the Westcotts podcast.
Thanks very much, John.
Thank you.